When I was having breakfast with my banker friend, he said Anthropic just ran a secondary. They capped it at $30 million per person because you have to put guardrails around it. He said 75 people hit the 30 million.
Oh, man. Have fun in the San Francisco housing market.
Yeah, right. You're gonna live in a hovel. But like, just to go through like three anecdotes, and anecdotes are what they are. They're a point in time. It's a conversation. It's not necessarily everybody feeling this. But CFO of a $50 million SaaS company, right? He's sitting next to me at dinner. Kyle, he's 6 years into this journey.
Is it venture-backed company, PE-backed?
It's venture-backed right now.
Okay, venture-backed, 50 million ARR, which a few years ago, that was the dream. That's like where you want to work.
And he's legit. And he's saying to me, I think, CJ, we're going to exit. We're having the preliminary conversations about exiting and hiring a banker in our next board meeting. I'm still thinking about leaving to try to hop onto one of these AI rocket ships. I've been here for 6 years. I could hear him like going through the thought process in his head, and I saw both sides of it. But he's doing the net present value with a tinge of FOMO on if he should stick it out. And once again, it's not a certain thing that they're going to exit, Kyle, but it's more likely now than it was before. And he hasn't exited a company yet, so it would be good for him.
But that is the question, like, who is buying a 50 million ARR SaaS company right now, and who's paying a strategic multiple on it? And so his job is going to be way harder. Probably people are going to be unhappy with him for not being able to sell it for a higher price. And yeah, I mean, his equity is probably not going to be worth what it was at its peak.
I think he thought that this was going to be a company that was going to exit for $1 billion a year ago.
And now what do you think it's worth?
He was hoping for 300.
That is quite a step down. Well, hopefully they don't have too much of a preference stack on the business too.
And that's the part that I don't know, right? I don't know how he's calculating his own piece of that, but also like you want to have an exit to something that you've started, right? It feels good just to complete the loop.
Although I do hope he asks his board for a carve out.
Yes. Yeah, he should. He should. So that's the first one. The second anecdote of mine is my banker friend. And I met him back in the day when I was at Sneak. Back then, we all thought we were going to go public. And I thought that maybe we'd be working with him. But either way, we're good friends now. And we always talk about what's going on within cybersecurity. He had like a vulnerable moment where he was like, dude, I'm getting pulled into like all these defense deals that I'm not a defense person. Like, I don't even know that much about like missiles and like building tanks and stuff. He's like, but I'm learning as fast as I can. And he said, it's a natural adjacency to the cybersecurity market, right? Like a lot of the cybersecurity stuff has some sort of relation to defense stuff. There's software built into the hardware. And what he was explaining to me is, I'm getting pulled into this because I need to tap into my network. My network is where I get the deals done. A lot of the CFOs that I knew from the cybersecurity places are moving over to these defense companies. So naturally, I have to go where the gravy train is.
And the defense tech companies are probably more near-term IPO candidates, if I had to guess.
Yeah, that's what he said. He said M&A right now for some of these companies that he was working with before is like a total desert. And so he's looking more towards not only the IPOs of these companies, like I'm making it up like an Anduril or something, but the follow-on debt offerings because they're so capital intensive because it's a full service bank.
He makes money based on the commissions or the kind of transaction value he's involved in. Cybersecurity seemed like a sure bet for a long time. Actually, what's confusing to me is like it felt like a sure bet. And I have to imagine cybersecurity is even more important right now with AI and all the sensitive data people are sending AI companies. Like, how is that not more of a lucrative position?
We talked about this. This is what breaks my brain because it's both, what did Dickens say? The best of times and the worst of times. It's the best of times in terms of cybersecurity being the number 2 initiative on every CIO's mind and CFO's mind other than AI, right? So it's AI, 1, and then like, I don't know, 5 steps down the rung, you get the B somehow. That's not how the alphabet goes. But either way, it's the second one, cybersecurity. So people are still buying it. The budgets aren't going down. A lot of these companies are still growing. But the multiple on publicly traded security companies in the last 18 months has fallen from like 7x to like 3 and change X. So the multiples are down despite not that much of a degradation in performance.
I feel like with security, it's one of those categories that has always had a very high retention rate. Customers been willing to lock in long-term contracts. Now it kind of feels like the best of breed security companies, like they're going through a generational change. And so it's not clear like which companies are going to be the winners and losers in this shift. And my guess is probably retention rates are, if not already coming down, like people are worried they're going to come down. Commitments are probably getting shorter. And so we're in this really odd time from a security perspective.
And then just the third anecdote, having lunch later that day with a friend who's an investor, and he just said, CJ, straight up, there's a blanket. Don't bring any pure SaaS deals to us. We're not doing them. It has to have AI or defense or hardware and compute attached to it. But we're just don't even waste your time flying out to meet with some of these SaaS companies.
And for which, like, what stage are we talking about? Is this like early stage investing or later stage?
This is Series B, C.
Oh, wow. So even at Series B and C, no SaaS. Because I mean, I'm not surprised with like a seed stage or pre-seed. Obviously, like at that stage, you want to back, what's coming. But you have to imagine there's like some pretty interesting vertical SaaS companies out there, like even now that probably have the future potential of an AI story, but they're not like primarily AI companies.
And it was weird because he was saying that is true, but we're also thinking about our reputation along with that. So it's this funny game where it's not just about, is there potential to make a return in this? It's how does it reflect on our brand saying that we are the leading AI and hardware investor for growth stage companies?
Yeah, I'm torn because you would think there's probably a really interesting growth equity opportunity right now where you've got a lot of like fairly high growing, pretty close to break even or profitable SaaS companies that the market is just totally overlooked, and they need some growth capital to, get where they're trying to go. But the valuations are a fraction of what they would have been a few years ago. There's part of me that's saying like, why is it, you'd think that there would be this like money going into growth equity and really snapping up these bargain investments. But at the same time, people are probably worried about like, you can't really flip these companies in a few years like you used to be able to.
And I think they're looking at it like the upside is a lot less than it used to be. It may be a stable thing today, but if you're playing for something that's a fun returner, are you able to underwrite that?
The common thread across your three examples were like, these are successful people. My guess is
Yes.
probably people in their 30s, 40s. They've built a career, and probably not a career that's been long enough to get rich, but like they've done well for themselves. They've got promoted. They kind of did the thing they were trying to do. And now they're looking back and going, did I make the right choices?
Yeah, these are three people probably around the age of 40, all with kids in private SF schools. And they're just kind of sitting there like, I feel like there's a great reshuffling and I'm going to get lost in the shuffle if I don't play my card right.
Yeah, the elder millennials are really feeling old these days. When I went all in on my newsletter, Growth Unhinged, last year, I quickly decided it was time to make the switch to Beehive. I chose Beehive because they're serious about powering the internet's best newsletters. Beehive's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on Beehive. You can host webinars on Beehive. And you can access Beehive through the new MCP. I just use Beehive's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, Beehive is a no-brainer. Try Beehive for free by going to beehive.com. That's BEEHIIV.com. Use Kyle30 for 30% off your first 3 months.